All right, everyone, we're back at the Grayson Business and Tax Podcast. I'm Brian Sweeney. I'm here with Kevin Gray. As always, we're both partners of Grayson. I'm an enrolled agent, certified financial planner, been in the business for 15 years. Kevin is also the same, certified financial planner, and enrolled agent, credentialed with the IRS, been in the business for 15 years. We're back. What are we talking about today, Kevin?
Well, there's a lot to talk about. Taxes get boring sometimes, but something that we both love, golf. Big golf
Golf.
tournament coming up next week.
That's right.
A hot topic, something that people discuss all the time. A lot of influencers, a lot of people on social media throwing the name of this tax strategy out there. Uh, let's spend a few minutes this week talking a little bit about what are they talking about? Where did this come from? How does this all relate to each other? And uh, it could be a really good thing, but it could also set you up for a lot of trouble
Yeah.
if you don't do it the right way.
Augusta Rule, man. The Augusta Rule. I
The
think everyone kind of
Masters
knows.
golf tournament, best golf
Yep.
tournament there is.
Surely, yeah. I mean, I think like what there's like I think I saw someone post there's like four major sporting events that the best sporting events in sports, the Masters I think was at the top of the list, like pretty much for everyone. They had like the Super Bowl, the start of college football season, the Masters, things like that. But yeah, man, the Masters is pretty awesome. But the Augusta Rule, the Masters is held in Augusta, Georgia. So the Augusta Tax Loophole is technically what's called in the tax world, but it's basically a way for you to rent out your primary residence and and do this tax free for up to 14 days. They came up with this idea because people in Augusta, Georgia, were renting out their homes during the Masters golf tournament, and they were like, "All right, we can't really control and tax these people on renting out their homes here. Why not just make this uh, nationwide and make this kind of like a loophole?" So basically, what it comes down to in a very simplistic format is you're able to rent out your primary residence for up to 14 days per year, tax free. So if I go to your primary residence and I rent it from you, you can rent it to me for $1,000 a night or a day, whatever it is. I'm going to pay you $14,000. You take that money completely tax free. You don't even report it on your tax return, just completely tax free.
Right? So you touched on a few things there, right? When you rent out a property, whether it's a vacation home, a rental property, an Airbnb, your office, whatever, typically that needs to get reported on your tax return. How it gets reported
Yep.
can differ, but the main concept is when you rent out a property, you have to report it. This is one of the few things in the tax code the IRS says, forget it, take the money. We don't want any of it. It's really amazing. And so, our main office is in Columbus, Ohio. Another big golf tournament every year. The Memorial Golf Tournament right around
Yep.
Memorial Day.
Absolutely. Yeah, it's coming up.
Um, we've been there many times, and some of these homes on these golf courses are nice homes to begin with. And then when
Yep.
you have an event, even the Super Bowl, it doesn't have to be a golf event, but
Right. It
you
can
could
be
be renting
anything.
your home out for tens of thousands of dollars for a 2 week period, and you don't have to report any of that for taxes. It's really amazing. Um, so the Masters is really where it started. Augusta, Georgia, the Augusta Rule. There's a lot of ways to take advantage of this. It's typically renting out a home that you own, your primary residence. Technically, it could be a residence that you don't even own, right? If you rent, you could still rent or sublease your apartment or your home.
Right.
That may be frowned upon by the landlord, but that's a different conversation. That's on the legal podcast that we don't do. Um, but yeah, there's a lot of options, and this is a lot of money that you can make and not have to pay taxes on. And then there's a lot of other strategies you can combine with that to get even more tax benefits, where not only can you pocket the income tax free, but you may be able to deduct that income if you're the one paying that income or that
Yeah,
rent.
so you're bringing up a good point. So because ultimately, right, the main thing that we hear from clients, we work with clients all across the country, nationwide. hundreds of clients. And the main thing that we hear from clients is what? Well, I don't really want to rent out my primary residence. Like, why would I do that? I don't want to do it. You don't have to. If you own a business and you want to rent out your home to your own business, so let's say you own a business, maybe it's an S corp, a C corp, an LLC, whatever it may be, you can rent out your home to your business, of which then that business takes this as a deduction on its profit and loss. So your business is deducting the rental income that it's paying you as your primary residence owner. And then you're able to collect that money personally tax free. That sounds convoluted. That sounds confusing. It is if you're not working with the right team. If you're working with the right team of tax professionals, this can be done very systematically, very easily, and very seamless. So the next question becomes, well, why would my business rent out my home? Well, if you own a business, maybe you have a couple people that work there. Maybe it's you and your wife that own the business. Maybe it's, you have a partnership with a couple of partners. Maybe you're going to have a board retreat for a couple of days, and you're going to rent out the whole room, the whole house, and maybe you have a 5,000 square foot house. You're going to rent for $2,500 a day for 5 days, right? I mean, do the math. So that's $12,500. So these are the things that they're not illegal by any stretch. They're completely legal. They're tax loopholes that people use and our clients use on an ongoing basis every year to get income that's tax free. I mean, that's the name of the game. The tax code was written to benefit people that are supposed to be benefiting from it. The people that benefit from the tax code are real estate professionals, or real estate investors, I should say, and business owners. If you're a W 2, there are ways to save money on taxes. Most recently, there are ways to save money on taxes if you are a W 2. There's some loopholes that have come out in the most recent years that haven't been there in prior years. But if you're a business owner, if you're a real estate investor, there are ways to save tens of thousands of dollars on taxes year in and year out if you're working with the right team on a yearly basis.
Yeah, and one thing that we didn't mention, we keep talking about 14 days. It doesn't have to be a 14-day period. That's
Right.
just 14 days for the
Could be one
year.
day. Yeah.
Yeah, could be one day, could be a quarterly get together, but why would they allow this? And why would you go ahead and do this? Well, think about it. If you're running a legitimate business and you're having a quarterly meeting with your employees or something that you may be getting together at the local hotel. You may be going to the Marriott in town to rent a room so you can have like a week long retreat with your employees across the country that are all coming together. You're going to go ahead and pay the Marriott. It may cost $1,000 a day to rent out a conference room, right? So if you're doing a week long conference or let's say 5 days, that's $5,000. Well, if I just do it at my home instead and host there, why would you not, let's take a step back. If it wasn't your home and you paid your neighbor to use their home, they have a nice pool, it's a nice location, and you want to use their home, you're going to pay them just like the hotel. So if you're going to be making your property available to your business, you can pay that, you can pay rent and use it. Right. So there's a reason to use it. Now, a lot of people get in trouble. This is like when you go on social media and you see people that aren't accountants saying, hey, open up a business bank account, go buy a Land Rover, write it off, free money, you never have to pay it back, declare bankruptcy or close the business. There's a lot of crazy stuff out there. None of that's true. There
No.
has to be a legitimate
Those
business
people obviously
reason.
they've never worked with tax advisors. They've never
Yeah.
worked with people that actually know what the hell they're talking about, that do it day in and day out, that work with clients. These are
Well,
people
what
that
what happens
probably
if the IRS shows up? They knock on your door. They say, "Brian, you paid all this income to yourself to rent out your home. Like, what was the business purpose? Do you have any proof that this is a reasonable rate that you charged yourself? If you don't do those things, then this could border on the line of fraud. If you're paying yourself $30,000 to rent your own property yourself and there's really no business purpose in doing it, that's severely underreporting your income and taking massive deductions that are not legitimate. You can get in trouble really quickly.
no question. So, guys, if you're thinking about using the Augusta rule, if you're a business owner if this is something that interests you, if you want to save money on taxes, these are the things that are going to come up. There's probably 100 different ways you can really save money on your tax bill. Maybe you owe 200,000 a year. You want to drop it to 50,000 and save yourself 150 grand a year. These are some of the things that we work with our clients on. We're not going to keep talking more in depth about the Augusta rule, but ultimately, the Masters is coming up. That's how it came about. It's a great tool to use if you use it the right way.
And for you gamblers out there, if you hit on any of your bets and you pick the winning golfer, winning, gambling, winning on your bets, that is taxable income as well. So
Yeah.
on another episode, we can talk about gambling
Now you
winnings
can
and
surely write off
losses.
your gambling winnings against your losses, which I'm sure are larger. But for all you
Well,
professional players
you
out there,
can't write off your losses as a deduction. Only
right?
offsets
Only
your winnings.
offsets the winnings. Yep,
We'll film that episode next time we're in Vegas.
exactly. Maybe we'll go a couple weeks. Who knows?
All right, man. Till next time.
All right, take it easy.